Hello, everybody. Welcome to our next panel. This is Digitizing Access, the Rise of Blockchain, Digital Assets, and Tokenization. Just to let you know that this is one panel. We have another panel in the next door ballroom at Ballroom 3, which is Product Strategy and Focus, in case you think you're in the wrong place. Today, we are blessed with three experts on the topic. We we're going to talk about what's happening in digital assets, but also and specifically in the region and in Dubai. Let me introduce my panelists for you. Um, to begin with, I've got Florent Junot, or Juano, I should say, Juano, the global head of asset management and distribution at Laser Digital. Next to him, Ryan Lamond, CEO at Neovision Wealth Management. And last but not least, Rachel Pethar, head of MENA at 3IQ. Thank you very much. I thought we would get the lay of the land here from Ryan to begin with, because Ryan has experience not only in investment banking and trading, but also in the regulatory area here in the Middle East, in the Gulf. So, Ryan, why don't you lead us off? Give us some sense of the background of the growth of digital assets in this market over here, given your background.
Perfect. Thank you very much, and great to be here. The UAE, specifically the retail sector, has been quite active in trading. So, when the cryptocurrencies and digital assets came to be, adoption rose very quickly in the UAE. As you probably know, in the UAE, there are multiple regulators, multiple financial zones. You have mainland UAE, regulated by what used to be called SCA, the Securities and Commodities Authority, which is today called Capital Markets Authority. You have DIFC, Dubai International Financial Center, and then ADGM, Abu Dhabi Global Markets. The first regulator to move to really holistically regulate cryptocurrencies and digital assets has been the ADGM's authority, the Financial Services Regulatory Authority. They really created a holistic regulatory regime to regulate that sector. Then obviously the DFC followed, and as we speak, the CMA is developing their own regulatory framework. And then we had a new regulator come up here in Dubai called VARA, the Virtual Assets Regulatory Authority, that was created just a few years back and that became the regulator for digital assets in Dubai. So it might sound confusing, it might sound a bit fragmented. It is. However, I do suspect that there will be some consolidation with respect to regulators across the UE regarding digital assets and virtual assets. Adoption in the UE has risen very quickly since. So today, I can safely say, if you look at adoption, so users and investors into digital assets to population, it is the highest in the world. It is roughly estimated at 34% today. Ancillary to that, the UE has created a regime um, to welcome basically crypto millionaires. As we know, Dubai is a very attractive city that attracts many, many millionaires. And Dubai was also quite um, quick in reacting to attract these millionaires by creating VARA and by creating a regulatory regime to welcome these millionaires. So it was basically a double whammy: regulate the sector and attract the players, the main players in that sector. One of them is obviously Binance, the largest broker in the world in cryptocurrencies, where its base today is the UAE.
Great. Okay. And you've been here quite a long time.
So I've been here since 2008. Absolutely, I've seen it develop from uh, very small in activity to completely booming in the past recent years. Absolutely.
Florent, you're a more recent addition here. Tell us about what's been happening more recently in the markets, where the demand is coming from. Is it coming from still from overseas? Is there enough interest here?
No, so there is domestic demand, but I think to Ryan's point, essentially the UAE has been very good in attracting the players, essentially under the regulatory regime such as VARA, which regulates the entire life cycle on both products from the issuance, custody, the market making, and also the distribution as well. it gives a clear framework, which sometimes lacks in other jurisdiction for players to come here, implement here, and then service a wider demand and international clients essentially on those verticals. So I think that's really what we have seen. Now, on the demand side, you obviously have domestic demand, a lot of family offices, hedge funds, sovereign wealth funds, pretty vibrant ecosystem, both in digital asset players, but also traditional asset players. But the majority of the demand is effectively coming from other jurisdictions, serviced by players, which can be implemented here.
Yeah. Okay. So, Rachel, you've also been here a long time. I think we've spoken a little bit about what is happening in your area because you're going to take an asset management perspective to digital assets. Perhaps you maybe talk a little bit about what's happening in the real world tokenization area, or in tokenization if you like. But what do you see happening?
So maybe just to give some context and then some clarifications around definitions. So 3IQ is one of the world's largest pure play digital asset managers. So we have the passive investment side of the business, the ETFs, and we also do actively managed strategies, but the underlying is all in digital assets. So when you speak about real world tokenization, and we were having this discussion before, most people think of the real world assets being real estate or art, but we actually include that definition to also include existing funds, so money market funds, equities, etc. From an asset manager point of view, we're always thinking about the supply and demand sides of the equation, or put another way, the cost and the revenue. And as an asset manager, we are always under pressure to bring costs down. And tokenization is certainly something that can help with that, whether that's financial cost or actually human capital costs. Like the number of man hours and money and time spent reconciling between systems, reconciling with counterparties. Blockchain technology can solve a lot of those issues, right? It's a single source of truth. So you cut down a lot of the administrative burden. So on the supply side, on the cost side, it does make sense. What we struggle with and would love to get the opinions of my fellow panelists is the demand side of the equation. Who is actually buying tokenized assets? There's a lot of talk about real world tokenization, multi-trillion-dollar market, you know, forecasts vary as they always do, but puts it in the multi-trillions. But who are the buyers? Because if you look at the benefits of tokenization, it's a 24/7 market. You can fractionalize, so you can take smaller investment sizes, and you can, get greater liquidity. For the sovereign wealth funds that we work with, they don't care about those things. They don't trade 24/7. They don't want fractionalization. They come in with large ticket sizes and they can negotiate their own fees. So perhaps my question to the panelists is, who are the buyers? Like, is it worth 3IQ tokenizing our funds? Where is the liquidity coming from?
Well, Florent, I mean, part of it is in the trading area rather than the sovereign wealth, the asset owners area, isn't it? So,
Yeah, I would say so. So essentially, the benefits really of tokenization, personally, I think, are one, the near atomicity, the fact that essentially settlement is going to take, a couple of instants, sometimes minutes, sometimes hour, but you dramatically reduce the T+2 framework into a T+2 hours to some extent, which is great. And the second area where we're seeing also a lot of money market funds being brought on chain is actually the use of assets which are tokenized as collateral, which means that any sort of asset that you put on chain, you can operate a repo transaction against it. And similarly, as your prime broker, as you would do it in traditional finance, you can finance those assets.
you would know, I would just to unpack this a little bit, you would normally use different things for collateral.
Yeah, or some of the assets just won't be recognized as eligible collateral for your prime broker. So, for instance, if we talk about private credit funds, private equity, venture capital funds, there isn't a lot of players which would actually take those assets as collateral and give you a line of credit against it. Thanks to on-chain, this is possible now, and I think it's a big differentiator. In terms of the money which is currently on-chain, just to give an overview as well. So right now you have around $100 billion of TVL on chain. The majority of the application and money which is locked is necessarily linked to credits, essentially financing operation and so on. And I think where Rachel and I, for instance, we're working on is effectively distributing funds which are tokenized on chain. And this segment right now represents around $20 billion. But it's growing very fast. And the first vertical where we have seen the majority of the growth is actually money market funds. Why? Because yield-bearing collateral, yield-bearing stable coins, atomicity as well makes sense for you to generate yield on any sort of transaction or payment in stable coins. And the second one is commodity, and last, private credit and credit funds. So all those segments are pretty much growing. Now it really depends on the use cases of the actors, I would say, to generate this demand. But in my opinion, tokenization doesn't really create demand. It just reveals a latent demand, which is already there.
Probably,
And
it's part of the plumbing, effectively.
yeah.
It makes it more efficient plumbing. Ryan, I know you have some strong feelings about
Yep.
tokenization. We should, at this point, say really what we're talking about when we're talking about tokenization, and because you were pointing this out in the definition, native versus not native, but because it could be just a,
Wrapper.
yeah, a wrapper, effectively, like an ETF, or it could be an actual digital asset. What you
So
want?
what is tokenization?
Yeah.
Tokenization implies that we're tokenizing something, right? We're converting something into a token, or the value or the future cash flow of an asset into a token. This is tokenization, basically. If it reminds me of something, you're right to be reminded. It's called securitization as well. Securitization out of a security, where we securitize an actual asset, a financial asset or a physical asset. So I just want to go back in time for just 30 seconds. You want to buy subprime mortgages. You want to get this 10, 15% per year return from subprime mortgages, right? You either have to go get a banking license and start lending subprime, or you can buy a securitized note that gives you exposure to subprime mortgages, right? This is called securitization. So the buyer of a securitized bunch of mortgages is someone who's looking for return of 10 to 15% without having to create a bank and lend money. Tokenization is the same thing. It allows us to get exposure on an asset, whether a real world asset like real estate, a painting, or it can be a financial asset.
Yeah.
Now, why do we do tokenization? Because we don't want to cut down, reduce costs, make it more efficient. So we created the first tokenized fund in the Middle East that invests into treasury bonds. So why do people would want to buy the token instead of buying the treasury bonds themselves? Because this would avoid them opening a brokerage account, going through KYC, compliance, the whole shebang. But effectively, it didn't really take off. It didn't take off for many, many reasons that we can discuss a bit later. Now, when you tokenize, and to answer your question, Alan, a fund can issue units, traditional units, and then you tokenize these units. This is not native tokenization. This is a wrapper. This is an additional cost. This is an additional layer. The way we've done it is native to the fund. So tokenization is embedded in the articles of association of the fund, where the fund issues tokens, not units. So this is native. It cuts down that additional layer of tokenization and additional costs. And hopefully, we hoped would provide more liquidity.
Yeah.
However, we confronted some issues like interoperability, travel rule, compliance, and KYC, which we can discuss in a minute.
But one other thing is that both would work whether you did it the sort of, I don't know, superficial way with the wrapper or the native way. Both would still work on chain,
I mean,
right? They do work.
Absolutely. Yes.
Yeah, yeah. So
So,
there's
so
no
the wrapper
difference.
one
There's no
works, and
difference.
most of the actual tokenized funds they do it this way.
It's not
The
that
wrapper
one
one,
is better, is it? Or I mean, it's native, but
the wrapper one is easier
uh-huh.
because you create a normal fund,
That's what I
a
mean.
completely normal fund. You
Yeah,
issue units, and then you tokenize each unit.
yeah. Fine.
It's the forgive me, I'll call it the lazy way.
Right.
Is
But
it the best way? I don't think so.
But from
Rachel.
the asset management sector, and I know
Mm.
Florent, you wanted to say something as well, but from the asset manager perspective, why there has to be the demand there? Because otherwise,
Yeah.
if I've already paid the cost and the administrative burden of doing a fund, and then I tokenize it, there is no cost saving to me.
Tell me about it.
So show me the demand, and then I'll do it. Otherwise, then we can actually look at the native tokenization, but I need to see the buyers.
Do you want to talk about
Yeah.
demand?
Well,
Yeah, I mean, about the demand right now, I think this will be evolutive as well. But what we are seeing today is really a demand for money market funds product.
Yep.
I know that maybe your fund has some hurdles in the distribution, but right now this is existing. We're seeing as well, um, to take a bit of a step back, essentially the distribution of those funds, it's linked to the entire ecosystem. So you need to have financial participants which are already using, for instance, a specific layer where those assets are going to be tokenized and settled on, which is a big questions here because you have a lot of various layers and so on, but also the entire infrastructure which is used for those tokenized assets or tokenized funds, the fund administrator, the auditors, etc., etc., the service providers. For instance, some people do not agree on custodians, for instance, selection and so on. So what is really important, just beyond essentially providing a fund or anything like that in a tokenized manner, it's essentially to think about the actual ecosystem where the tokenized asset will be placed in. And then you can have organic demand. So for instance, we're seeing a lot of demand on a layer called Canton, for instance, for leveraging what we call the atomicity of the chain, the fact that you have real delivery versus payment, you do a transaction and immediately after you're going to
This is
receive a
where
proceeds.
we could see big volumes potentially,
Yeah,
right?
but I think we're
As a
completely
use
agree.
case.
But
Yeah.
where what they're doing differently than the others is that they manage to organize this ecosystem. So they have, for instance, CSDs, they have banks, they have asset managers, hedge funds participating into this ecosystem. So here it makes sense. It's still decentralized, but at the same time there are certain perimeters on the ecosystem. To come back on essentially native tokenization or I would say asset reference tokenization, Vara has just done a new framework called the ARVA framework, asset reference virtual assets framework, which actually recognize both really. So I don't think it's an issue from the investor point of view to select whether the native tokenization or just the asset reference. To some extent, it's as if you were long synthetic instead of being, for instance, long spot funded. Uh, but economically speaking, I don't think it changes anything.
Alan, if I may, I just want to go back to securitization just for 1 second.
Uh-huh.
So, banks, what they do, you deposit money at the bank, right? They keep 20% reserve and they use 80% to lend it to someone who's looking to buy a house. They give mortgages. This is how it goes until they reach the limits. They've lent all of the money. So, how do banks continue lending? They package these loans and they sell them to an institutional investor, right? This is securitization. So without this, banks could not lend as much as they lend today for people to buy homes. The same thing with tokenization. What the biggest missing piece that is missing there is the institutional investor. It's that guy who's taking that packaged asset and invests into it because this institution wants exposure to that asset. This is what we're still missing. Most of the demand that we see at the moment is more retail, small investor, and individual. There's no real institutional wide scale adoption. At least this is what we face.
Yeah.
Until we see it materializing, like we've seen in mortgages, I think adoption and demand will remain weak.
Yeah, so within the ecosystem as well, maybe just to extend a bit. So as I was saying, the majority of the 100 billion of TVL on chain right now is in credit. Essentially, people lending peer to peer, either using their asset as collateral or just unsecured financing or secured financing. Um, Out of that, essentially, it develops another market, which is, let's say I'm providing a VC fund, private equity fund, or just a hedge fund strategy on chain. Depending on the depth of this credit market, which is on chain, I might be able to lever essentially the strategy
Okay.
multiple times.
Right.
And the advantages of the on-chain system is that here you don't rely on, let's say, one fixed curve in terms of the lending. You're going to have peer-to-peer participants, which might be, for instance, more familiar with your credit profiles or like what you're doing and can lend you at preferred terms, I would say. And so the financing conditions on chain are very different from the financing conditions outside, which means that hedge funds, for instance, are spending a lot of time and efforts to source capital on chain to potentially lever their investments, whether it's on chain or outside, actually,
Yeah.
of on chain.
And there's a lot of moving bits on chain and off chain to kind of take from, I dare I say, well, traditional world stuff into the digital world and then back and forth. And they kind of need to stop doing that, don't they? And keep it all in the same ecosystem. But there's still some resistance, right?
I think there is some resistance, but medium term, both are going to be merging. And essentially, the financial architecture that we're seeing in TradFi for TradFi participants will be, for instance, relying sometimes on on-chain settlement rails, but it will be pretty seamless for them. They won't be able to realize actually that, for instance, their transaction is settling on-chain. This is probably what will happen in the next 3 to 5 years, in my opinion. Yeah.
And so, Rachel, you're hinting at the fact that I guess you're talking about your clients are sort of still not quite on board with this. They're watching very carefully and are interested, or there isn't enough demand. You're sort of suggesting.
So there's two sides to that. So on the client side, we have a lot of people from TradFi and crypto native people within the firm. We know that there's a client pool out there that is interested on the tokenization side, but most of what we focus on at the moment is sovereign wealth funds and family offices. And I don't think that many of them are comfortable. With the institutional investors, you were talking about this friction between traditional finance and DeFi, off chain, on chain. And I think we just need to reduce those friction points as much as possible, whether that's operational, lack of knowledge, resourcing, whatever those reasons are. I mean, there will be a point where we don't talk about TradFi or DeFi, it will just be finance, right? That's the world that Florent was referring to, where it's all just converged. But I think now, on the tokenization side, it works well in a market where there's a lot of friction points and you're reducing those friction points. I think now for individuals, it's still quite challenging to know how to even enter this space. I mean, the on and off boarding to get on chain can still be challenging. You mentioned Binance before. I think as a retail investor, you can buy 15,000 dirhams worth of Bitcoin a day, which is, if you're an institution that's wanting, or a high net worth individual that's wanting to buy 100,000, that's going to take you a long time. And that's just buying Bitcoin on an exchange. Then investing in a tokenized money market fund is quite a few steps further down that. But I think, there's the operational considerations, there's the regulatory considerations, there's the just getting familiar with it. And then there are these frictions between the different regulatory environments, like can I transfer assets? And so there's still a lot of considerations, but we've come so far in the last.
Well, I mean,
5
those are
years.
two important kind of things we should talk about. One is the interoperability issues, right? Because there's a lot of different blockchains, some of which we've never heard of. We know the big names like Ethereum, and Solana, and things like that. But there are a number of others that are probably have very good qualities. But how do people decide? I mean, I was we were talking earlier, and one large U.S. manager in the digital asset space was saying that, oh, we use as many as we could possibly use. It sounded to me like they were a sort of scattershot strategy, hoping that one would survive, but they didn't seem to see it that way. How do you all see it?
I mean, first you have to consider that essentially there is primary issuance for tokenization, and then there is secondary trading.
Right.
So I would say that as of now, tokenization as a whole is commoditized enough so that you can, to some extent, tokenize a fund or whatever financial instrument product, which is a security on whatever chains, actually. So this is doable. But then the reality is, who is going to trade that on which ecosystem, whether it's Ethereum, Solana, and many others, Aptos, and the rest. And so, therefore, here it's very complex because you need to tokenize your instrument on the right chain so that ecosystem participants are going to do actions with it. The majority of the actions that we're seeing right now is the ability to use your assets as collateral to borrow more, potentially lever your transaction or engage into other operations. So if you do that on an ecosystem where there is limited amount of users and so on, it tends to be quite complex. As you said, I think we have a couple of great layers right now which are widely adopted, which are Ethereum based, notably mainnet Ethereum for issuance and for secondary trading, what we call layer twos like Arbitrum and Optimism, for instance, and all the ZK layers. But and Solana, which is different in terms of programming language and so on. The interoperability system is actually sorted because you have a number of players, very innovative as well, like Chainlink, Wormhole, and Layer Zero, for instance, which are offering bridges essentially across all those various chains.
So you won't have to worry about which one.
They are completely, I mean, obviously from a technological point of view, they are doing it in very different manners, but essentially they're abstracting the complexity of understanding where it settles.
Yeah.
And
But I think for a real world traditional investor, they'd be kind of thinking, well, I don't know, I just assumed I bought something and it happened. I own this asset or such. But it's more complicated that they have to make decisions. I guess we need to just see it as the software they choose effectively, not so much anything else. But sorry,
That's the
go ahead.
opportunity of improvement, I think.
Yeah.
You want to buy 10-year treasury? Do you have to worry about chain? No. You just go to your broker and
Yeah.
you buy 10-year treasury, period.
Yeah.
Right? So this is, I think, one of the hurdles
Yeah.
that the virtual asset
Yeah.
space has to
There's too
resolve.
much competition.
I mean, which chain to use? That shouldn't be even a consideration
Yeah.
for the end
Yeah,
user.
exactly.
I want to buy a money market fund.
Mm,
The token is there. I just click buy.
mm,
That's it.
But
yeah.
I would say as well the diversity of the actors, which are so. For instance, I can buy a money market fund, and frankly, if someone sees my transaction, I don't care. You see what I mean?
Uh,
Now, let's say you're a big bank. You don't necessarily want your transactions to be public on permissionless network, and so therefore, I would say that depending on the type of actors that you have, you're going to have a list of requirements in terms of governance, for instance, of the chains, privacy-related questions about whether they can reconcile transaction, regulatory requirement, because if a transaction has been done unlawfully, for instance, we need to come back, for instance, on this, and also the enforceability of for instance, smart contracts for distribution. So let's not forget that actually tokenization is also very important from a regulatory point of view, where you can embed a certain amount of rules at smart contract level to authorize the distribution, for instance, of your funds to certain jurisdiction, which is quite paramount. It's quite big. What tokenization at the end of the day is solving, it's not necessarily creating new demands, but it's an add-on for distribution and also for operational efficiency, as Rachel was saying.
And I think the collateral piece is huge. Like, as we see that continue to evolve, if you can use your tokenized assets as collateral, and that just unlocks a whole new market. So that's definitely an interesting space that we're looking at.
Oh, that's crucial because with securitization, what happened in 2008, where I'm holding this note that tells me I have exposure to these things, that doesn't have value anymore. So I think with tokenization, that's a crucial point where my token will not lose value when the actual tokenized asset did not lose as much value. You
Yeah.
see? And
I mean,
2008, this is
basically,
what
we're talking
happened.
about proper collateral behind
Yes.
asset backed.
So this is what happened in 2008. You thought you were asset backed, but you weren't.
No.
Okay. And I think this is why today, if you look at gold and silver, the demand for gold and silver is lower than physical demand for gold and silver. The difference in price between physical silver and paper silver is 30% because people want to buy physical silver. They don't trust the paper silver anymore.
Yeah, yeah, and we don't actually in the just talking about that we see some sort of stable coins backed by gold and silver, but it's not as much as I would have expected by now. But maybe I missed something. But what were you going to say? One,
No, I mean, so yes, we are seeing a number of stable coins which can be backed by a single assets, but the reality is, I think it depends also on regulation as well, right? So, for instance, a
which
circle
is
is going
another
to
thing
have
to talk about.
very different rules than, let's say, a Tether. But what is interesting is the reserve of those stablecoins provider tends to be quite well diversified, sometimes with tokenized assets as well or commodities. So to some extent, I think the reserve of those stablecoin issuer can be comprised of gold, for instance, to an extent, as you were mentioning, which is actually the case as well in traditional finance, right? Because when you think about it, you're going to have central banks holding gold as well. So it's relatively similar.
Yeah, yeah.
Rather than backing, I'm going to call it convertibility.
Right.
I want to be able to convert my token into a fraction or the actual assets,
Mm.
just like pre 1971 or pre Bretton Woods, where you could take your $20, go to the Fed, and they give you gold instead.
Yeah,
That's how it was.
yeah,
And this is the level of confidence that we need in that space.
yeah. But you can't really do that very easily in some illiquid areas, can you? Like real estate. You could,
Yeah, with real estate, that would be complicated. So instead of actually converting into an ownership into that building, it converts into a cash flow
right.
where I get 0.01% of the cash flow generated from that building, for example. Obviously, I cannot get ownership.
Yeah.
But to come back on the backing, for instance,
Right.
where we were talking about commodity and so on, the difference between the traditional financial ecosystem that we're in and what is happening on chain is that the on chain part is actually provable.
Mm,
It's transparent. You can check it,
mm,
and everybody can check it.
mm.
So,
Which is good and bad.
which is good and bad, exactly.
Uh,
It creates other problems, but at the same time, I think it's an improvement in the next generation of financial architecture.
huh, yeah. And I was going to ask about regulation, because regulation is always going to vary with in any securities market anyway. So is it? They've tried to make it a lot easier here. Has it worked? Has it made it more attractive to operate in digital assets here than anywhere else?
Well, as an ex-regulator, it's always a problem regulating a sector, a
Yeah.
new sector.
Yeah.
So usually how it goes, the regulator is really late to regulating
Sure.
a certain sector.
Mm.
So what happened in the UAE is some of the regulations tried to be a bit ahead, and this I think slowed down things a bit. I'm not going to mention a specific regulator. Um, Another is restricting. So you could not invest unless it's part of a pre-approved list. See? So there has been a bit of um, uh, it was a bit prudent or over prudent in certain aspects. And other regulators were actually no, it provided comfort for many of these companies to come and establish in the UAE. So if you look at the list of companies that are regulated in the UAE today in the virtual asset space, it's absolutely impressive. I don't think there are many jurisdictions where there's so many top blue chip names in the virtual asset space as in the UAE. So this tells you something also about the regulatory framework.
And is that, I mean, it's made it easier for the two of you to stay, but you've arrived partly because
I mean, to
this,
Ryan's point, it makes total sense. Like, for instance, Laser Digital, our asset management and trading operations are also based in the UAE, in Dubai, under Vara and ADGM. So the ecosystem here is very vibrant. Like, I've been in the space for multiple years, and the majority of our competitors, if they're not established in the UAE, they're coming.
right. Yeah.
So, yeah,
This is the place to
yes.
do it because it's so easy to go. Yes, Rachel.
Yeah, 3IQ has an interesting relationship with the regulator in Canada. So we actually wanted to invest in Bitcoin back in 2012, and we went to the regulator. We were regulated by the OSC in Canada. And as you can imagine, they said no. We went down the rabbit hole. And then in 2016, Canada had its FTX moment with the downfall of Quadriga. So we went back to the regulator and we said, look, this is what happens when you don't regulate the space. Investors get hurt. They still said no, so we actually sued the regulator. We took the regulator to court for the right to be regulated, and it was a 3-year court battle, which eventually the judge, in the case of 3IQ versus OSC, ruled in favor of 3IQ. Bitcoin was deemed a security under Canadian law, and we launched the world's first Bitcoin ETF.
Mm.
It was out of Canada, so it didn't get as much headlines and traction as when the SEC approved it. But all that to say that we've had a history, we now have a very good relationship with the OSC. They're still quite progressive on the ETF front, on the passive front. But by far, and we've been going around the world talking to regulators about how they can regulate the space. The UAE has just been so advanced and open to learning because we're all learning in this space, like even people that have been working in it for a decade. It's a very young industry. And so I think what the UAE has done, particularly VARA and the ADGM, is been really open to what are the challenges they want to hear from industry, what are the challenges that the industry is facing, and how can we help rectify that? And it's paid off. It's paid off in leaps and bounds. They now have a very thriving ecosystem here.
I'm just going to open it up for questions as we got a little bit of time left. If there are any questions, this is a good time to ask. Otherwise, I'll keep going. I'll keep going then. So one question I have, well, is an obvious one really, which is what's the next steps here? What's the next thing that you're really looking forward to in the digital asset space, Rachel? Here particularly.
So I would love to see genuine demand from a group of investors that we don't yet have access to and really enter the tokenization space with what we have.
Right. And tokenize, as we discussed it, not necessarily art and stuff like that, but more useful, not useful, but you know what I mean, funds, really, securitized products, right? What's the one thing you're looking for?
Institutionalization, obviously,
The what?
it's institutionalization. So more institutional investors coming in.
Mm-hmm.
And again, I'll go back to the analogy of mortgages.
Mm,
Without that institutional investor buying packaged mortgages,
mm-hmm.
banks cannot lend as much as they lend today.
Mm,
And the same thing with tokenized assets. You need that institutional investor component for this whole sector to actually take off and become mass adopted, just like, and I join you, Rachel, in saying we don't have TradeFi anymore. It becomes finance.
it becomes finance. But in the case of the MBS, there was a lot of demand for mortgages, natural demand. Would there be enough demand on the digitalized or
So
tokenized area that you
let's look
expect?
at the assets where there's demand. So today there's absolutely enormous demand for physical gold.
Mm,
Demand is there.
mm,
Let's look for areas of real world assets where there is demand
right.
and build tokenization
And
on
build
top
it
of
off
it.
of that.
We tried to do that with treasuries. There was
Mm,
a lot of demand on treasuries when interest rates went up.
mm,
So we tried to ride that wave. So I think you go to the institutional investor, what do you demand? And we tokenize that demand.
mm,
It's interesting because, and sorry to interrupt, but digital assets is the only, let's call it asset class. I actually don't like to call it an asset class, but that's another story. It's the only asset class that was born in retail. So all the other things, like money market
Yeah.
funds, ETFs, it all started at the institutional level. Digital assets started like it was very much ground up. It was like this movement almost against the institutions. So I think that's why it's taking
yeah,
longer for the institutions to come
yeah.
on board.
It's a kind of political movement almost, yes. And finally, Florent?
Yes, what I am really looking after I'm pretty excited by is right now on chain there is a small revolution which is called vaults.
Right.
And so vaults to some extent it's a wrapper of a
It's
number of
vols?
vaults
Volts.
of a number of tokenized products.
Right.
And essentially here you can make the most of tokenization because tokenization is also about programmable, for instance, cash flows and assets, but also about rebalancing frameworks.
Hmm.
And essentially those vaults allows a licensed asset manager to rebalance a number of tokenized products and also use these vaults directly as an entire collateral. So I'm pretty sure that we will see over the next few years a lot of good use cases and application on the back of those vaults, which can include, for instance, actual securitization as well.
Okay, finally. Um, we're pretty much done now. Are there any more questions? Otherwise, I'll probably wrap it up right here. Um, okay, I have one question here. Thank you.
I have a question on the fact that, as if I was an institutional investor, um, I'm not going to be buying as a pension fund in Europe, for example. I'm not going to be buying Bitcoin or Ethereum or any of those things to add to my, allocation. Even if I wanted to diversify and get that exposure, I would look for that exposure through some regulated means, right? So I'd go and buy an ETF that held those components, or I'd go and buy a fund, or I'd go and buy if I wanted to hedge it, I'd buy a derivative instrument that held that exposure. So isn't it a case where, in order for crypto or crypto assets to really find their way to a new, I guess, level of adoption, that they'd have to chart that way through the TradFi markets anyway? I mean, I go to your point earlier, which was about the rails. Like, when you go and buy a money market fund or an ETF or whatever, you don't have to make that choice. That choice is being made in the background somewhere. It's a back end issue. It's not my issue. So, my question really is, isn't that the path to success? rather than going all this way to zigzag somehow to eventually what will become a TradFi play anyway.
So I can start with that piece. So I think one of the challenges that institutions had when they wanted to enter the digital asset space was that they weren't familiar with the counterparties, right? They would have to go in, if they did, assuming that they wanted to bring Bitcoin into their portfolio, they would have to open accounts with exchanges. They didn't recognize any of these counterparties. So when the ETFs came in and they were regulated, they were with counterparties that they knew and they understood, that was a great entry point because that really brought more people into the space. There's already the investment risk inherent in digital assets. It's a volatile asset. We know that. But there are all those other risks that investors have to consider, which you just don't need to think about in TradFi. So, who's your custodian? Who are your counterparties? And so, I think as those participants in the market get better known, they get regulated, then that will help give the institutions a greater peace of mind to access the space. But absolutely, I mean, you would never see you know, a CalPERS investing with a manager that's unregulated. I mean, it's just not worth the risk for them.
Okay, I think that's all we have time for. I'm going to leave it there. Thank you very much to my panelists. Thank you all for listening. I hope you enjoyed that.